Most people who have money sitting in a savings account already know they should be doing something with it. They're not confused about whether investing matters. They're stuck on something more specific. What if I pick wrong? What if the market drops right after I buy? What if $2,000 isn't enough? Those questions are reasonable. Every one of them has a clear answer. An ETF holds hundreds or thousands of companies in a single purchase. Instead of betting on one company and absorbing everything that happens to it, one ETF transaction gives instant diversification. If one company inside has a bad year, the rest carry it. Carrying all your eggs in one basket means dropping it ends the trip. Spread them across 3 baskets and dropping one changes nothing. That's the structure that keeps investors in the game when things get uncomfortable. The difference between an ETF and a mutual fund comes down to one number: the expense ratio. A mutual fund pays a manager to decide what goes in and out, costing between 0.5% and 1.5% per year, taken from your investment regardless of performance. An ETF tracks an index automatically, with no manager involved. Most quality ETFs charge between 0.03% and 0.20% annually. That's the first number worth checking before putting a single dollar anywhere. Now meet 2 people starting from the same place. Call them Sarah and Kevin. Both have $2,000 and open a brokerage account on the same day. Sarah puts her money into a broad market ETF, turns on automatic dividend reinvestment, and doesn't touch it for 20 years. Kevin researches for 3 months, talks himself out of starting, and parks the money in a savings account instead. 20 years later, Sarah's $2,000 has grown to roughly $27,000. Kevin's sits at about $4,400. The gap isn't about talent, it's about whether the money was actually in the market. 3 ETFs form the foundation of a solid beginner portfolio, each with a specific job. The first is VOO, Vanguard's S&P 500 ETF. It tracks 500 of the largest US companies in a single purchase. Expense ratio 0.03%, average annual appreciation around 13%, and a track record that survived the dot-com crash, the 2008 financial crisis, and the 2020 pandemic. VOO's job is stability. It's the foundation everything else rests on. The second is QQQ, the Invesco Nasdaq 100 ETF. Where VOO spreads across 500 companies in every sector, QQQ concentrates in the 100 largest non-financial Nasdaq companies, predominantly technology. Expense ratio under 0.20%, historical annual appreciation around 19%, though that figure reflects a particularly strong decade for technology and may not repeat at the same rate. Its job in this portfolio is acceleration. VOO provides the floor, QQQ raises the ceiling. The third is VXUS, Vanguard's Total International Stock ETF. VXUS holds over 8,000 companies across developed and emerging markets outside the US, Europe, Japan, China, India, Brazil. Expense ratio 0.05%. The US market has outperformed the world for the past decade, but it won't always. VXUS ensures the portfolio isn't dependent on one country. Its job is balance. With $2,000 to start, one possible approach looks like this, though the right split depends on individual risk tolerance, age, and financial situation. Half, $1,000, goes into VOO, where the stability lives. 30%, $600, goes into QQQ, enough to push the long-term return without making everything swing with every Nasdaq headline. The remaining 20%, $400, goes into VXUS, adding geographic coverage without diluting the growth story the other two are building. The actual buying process takes about 15 minutes total. Open a brokerage account at Fidelity, Schwab, or Vanguard. All free, no minimums. Transfer the $2,000, then turn on automatic dividend reinvestment before buying anything. Then search each ticker, enter the dollar amount, confirm, under 5 minutes per fund. What happens after the purchase is where most beginners go wrong. Every instinct says to do something, check the balance daily, react to headlines, move things when one fund outperforms another. The portfolio will drop at some point, not might. Will. The investors who lost money permanently weren't the ones who held. They were the ones who sold and never got back in. The entire maintenance plan is one annual check. Look at allocations, rebalance if needed, close the app. At a blended annual appreciation of around 13%, based on historical averages, not a guarantee of future results, $2,000 invested once could grow to approximately $8,000 in 10 years, $30,000 in 20, and over $107,000 in 30. Not from adding more money, from leaving what's there alone long enough for compounding to work. The first year looks slow because it is. That's what the beginning of 30 years looks like. The questions that stop most people: is this enough? Is now the right time? What if I pick wrong? Don't have perfect answers. What the data consistently shows is that waiting for perfect answers costs more than starting imperfectly. A portfolio built on 3 low-cost ETFs and left alone for decades isn't a complicated strategy. It's the one that shows up in the financial histories of people who built wealth quietly. This isn't personalized financial advice. Everyone's situation is different, and a qualified financial professional can help tailor an approach to yours. $2,000 isn't a small amount to start with, it's a start.